Hey, good morning. This is Mayor Valensky with Driving Markets. Okay, so what we're going to do is we're going to look at what's likely to happen in 2024. So in 2024, you're going to have an election year, and obviously you're going to have Biden who wants to rerun with his administration. In addition to that, you're going to have a banking crisis. Why are you going to have a banking crisis in 2024? Quite simple. March 2023, there was a banking crisis. Remember, First Republic, Silicon Valley, Silvergate, all of them went bust. And then the Fed and the US Treasury came out with an amazing idea. They said, you know what? Let's lend the banks some money. Why did the banks go bust? Because interest rates went up so much, yields on the bonds went up so much, and the price of those bonds dropped, and therefore the banks, the regional banks in the US that essentially invest in US treasuries, the net asset value that they're holding dropped, and therefore their liquidity was a problem. They had less liquidity. So the Fed in the US Treasury came out with a solution and called it the Bank Term Funding Program, the BTFP. And the BTFP is quite simple. It's a program that finances the banks to the tune of $60 billion. That was the fund set up. However, that fund somehow, under the radar, without anyone seemed to have noticed, has gone up to $128 billion has been loaned out to regional banks, and it is rising. That fund and those loans are rising. Why? Because the regional banks are in severe difficulties. Not only the regional banks are in difficulties, insurance companies and pension funds also invest in US treasuries because it's literally like cash. You just take cash, it's a cash deposit, and you get paid interest on the cash. That interest is the yield. Now, those bonds have gone down in value. The yields have gone up. So what did the Fed do? The Fed comes out and says, right, we are now going to reduce interest rates in 2024. We're going to tell the market what we're going to be doing. And by telling the market what we're going to be doing, it means the yields on the 10-year treasuries are going to fall. The bond prices are going to go up. And therefore, by the bond prices going up, they're going to save the banks. Why are they going to save the banks? Because it means the bond is worth more money. As the yield falls, the bond prices rise. It's seesaw. It's quite simple. Yields go up, bonds go down. Yields go down, bond prices go up. So what the Fed wants is the bond price to be higher. Two reasons. Number one, to save the regional banks, and number two, to save themselves. Why? Because when the Fed and the US government comes to issue debt, to issue money, wants to borrow money from the public, and wants to make out that those bonds are valuable. By reducing the yield, it makes the prices go up and therefore becomes more attractive in the marketplace. However, Joe Public in the US and around the world is not being fooled. They're worried that Uncle Sam, the US government, will not be able to pay the interest on these bonds. As a result of that, the US was given a negative outlook by Moody's credit rating agency. US debt is huge, and there is a possibility that the US could fail to pay its dividends, pay its interest. Now, unlikely they will do that. However, the banks who are the biggest purchasers of the US bonds, with Saudi Arabia and China, who now don't buy US bonds, so it's left to the banks, they're demanding a higher risk premium. Why? Because they think the US is in pretty poor condition. So they say, you know what? We want to get more interest on these bonds because we don't believe that Uncle Sam is going to be able to pay the interest on these bonds. Going back to the Bank Term Funding Program, that finishes in March 2024. So all these regional banks who've borrowed money temporarily to support their balance sheet and make them look stronger now have to repay that in March 2024. In March 2024, they won't have any money. So what will the Fed and the US Treasury probably do? They'll probably expand the loan to about 200 billion or 250 billion or 300 billion, extend the terms in order to keep the regional banks intact. However, it's unlikely that's likely to happen. And the KRE, which is the ETF that measures regional banks, has gone up 50% since March 2023 due to this banking crisis, due to the fact that the loan fund has stabilized the banks. However, that stability of the banks is now going to fail because they've got to pay back $128 billion back to the US Treasury, which they don't have. And that is going to cause a second major banking crisis, bigger than the March 2023 one and bigger than the 2008 banking crisis. We are talking about hundreds of billions will be lost. This is Mayor Walensky with Driving Markets. You can share, subscribe, comment. Catch you later.